Hi, I am Patra Francis. I am a real estate investor and tax strategist, and I am excited to walk you through this property that is as an example of the type of property that we like to invest in. And today I have Tyler, Leon,
Lyons.
Lion, and Mark Purver CPA here. Tyler, Leon. If I pronounce your name correctly, if I apologize. He is a co-GP managing this property here, and he's gonna help us to, he's gonna talk about how we evaluate the property and how we look into the deals and how we can work together when the deals are similar to this property. The question for you, Tyler, we want to, can you talk to us more about this property? That how long have you been having this property, and how many units do you have here?
Yeah, so this property we purchased a little bit over a year ago. So we bought it we actually closed September 30th of last year. So we're coming up on 1 year since we acquired this particular property. This is a property that we found that was marketed by a broker, and we're focused on the Phoenix market. That's the only market that we buy properties in currently. So we've got really good relationships with the brokers in the Phoenix market. We're networked with them. We get to see the deals as they come out, some of them that are marketed, some of them off-marketed as well. This was a deal that was fully marketed to the public, and we found it through our relationship with the broker, and we evaluated the deal and ultimately purchased this deal again back of September of last year. And we purchased it for about $800,000 less than the highest bidder. So because of the reputation that our group had, our kind of sponsorship team, ASIM Capital, the folks that we partnered with to purchase this property, were able to get a pretty significant discount on this particular property, which obviously is really beneficial. That benefit passes through to our investors, and part of it's our reputation. And then also, it's a good point of like why you need to stand behind what you say, because the group that did have the highest offer, they had a reputation of backing out of deals in the past. So even though we weren't the highest bidder, we're able to come through and get what we think is a really excellent deal.
Awesome. And what type of value add that you put into this property when, how can you make sure that your potential your investor going to get a good return of the investment?
Yeah, so every time that we acquire a deal like this, we always try to have some level of conservatism baked into our underwriting for the deal. So for this particular deal, we were very conservative on the rent growth assumptions. And as we kind of see, how the property has performed so far this year, we're doing pretty good compared to our pro forma. We're about 8% ahead of our year one pro forma right now. So it's always good to have some conservatism baked into your underwriting model. Another area where we felt like we were really conservative in our underwriting model as well was the exit cap rate. And it's kind of a technical term, but what I mean by exit cap rate is when you sell a multifamily property, the way a multifamily property is valued, it's basically a multiple of the income that the property produces. So typically for a property like this, we purchased this at a cap rate of about 5.7%. And we assumed that we would sell the property at a 6% cap rate after a 5-year hold period. So basically what that means is we assume that basically the multifamily assumptions get worse over the course of a 5-year period, because a 6% cap rate basically implies a lower valuation than what we bought it for. So I think that's really important when you try to protect investor returns, really having that conservatism baked into your assumptions.
Right. And can you talk to us more about what type of return that you usually can generate to the investor in terms of the cash on cash return and at the exit strategy, right?
That's a great question. So typically for this type of deal, this is a mid-70s vintage Class B value add multifamily deal. For this type of deal, what we usually aim for is a 15% internal rate of return, which basically means you take the return that the property generates, and it basically takes into account the time value of money over that period of time. So 15% internal rate of return is kind of your overall return for the property. And kind of breaking that down into some different metrics, an equity multiple of 1.9 to 2x is usually what we aim for as well. So that would mean if you're an investor in this particular property, which this particular property had a minimum of $50,000, an equity multiple of 2x would mean that you turn a $50,000 investment into $100,000 over the course of a 5-year hold frame. And from a cash on cash perspective, cash on cash return basically means as an investor, that's the cash yield that you receive from the investment during the hold period. It runs the gamut a little bit in terms of expectations there, but for something like this, it's a mid-70s vintage Class B property. I'd say you're looking at, on average, somewhere between 5 to 7% cash yield during the hold period.
Gotcha. And you know, I am pretty risk adverse, right? And I like to look at the worst part. So when you invest into multifamily like this, what is the worst thing could happen? I know that, you know, we have an asset, we have like a property, and my understanding is when you buy an apartment, it works differently than when you buy a single family home, which is just based on the fair market value. But when you buy an apartment, it's based on net operating income, right? And maybe you can tell me more about, you know, what is the worst thing could happen when you get into, like, when you invest into multifamily?
Yeah, it's a great question. So there are a couple pieces there that I'll dive into. So in terms of the worst potential things that could happen, you know, these are alternative investments technically, so there are risks associated with them for sure. But in terms of the risks that are at play here, some of the big ones that I'd point to is you need to be aware of supply risk is something that's pertinent and very important right now. You know, to the extent that you're investing in a market, if there is other multifamily properties being built there, that's something you need to be concerned about and thinking about, because that could impact the demand for the asset that you invest in. The biggest risk I would say though, and where I've seen people get burnt the most over time, is usually when it comes to the debt terms. Because when it comes to investing in commercial real estate, usually you have a balloon payment that is in effect for your loan. So you usually get a loan for a 5-year term, 7-year term, 10-year term. Those are usually the terms that you see. So the timing and the duration of that loan is really important, because where I've seen people get burnt the most and really, you know, lose money, lose properties, that sort of thing, it's usually situations where there's a debt maturity that they're not ready for or not contemplating. So you always really want to understand the terms of the debt, when that debt matures. Is it fixed rate debt or is it floating rate debt? I always really encourage people to pay very close attention to the debt side of things.
Gotcha. Yeah, the debt can eat up all the cash flow, right? That's why we have to pay attention to that. So maybe you can walk us through the process of your underwriting, because when you buy an apartment like this, it's almost like you buying a business versus when you buy a single family home, you just take a look at the comp around the area. What is the process of your underwriting?
Yeah, great question. So basically our process for underwriting a deal is basically we look at what the financial operating results for the property are as of today. So we get the trailing financial statements, we get the rent roll that kind of shows, okay, who lives in the property, what's the rent that they're paying, and we look at those things and analyze them, and we try to make projections around what's our business plan going to be after we purchase the property. And whenever we do that, you know, we've got experience underwriting literally hundreds of deals in this market, operating and investing in many deals in this market. So we've got a pretty good feel for, you know, what the rents of the property could be and should be. We've got a good feel for, you know, what the expense load for a property should be, what all the departments should run at from an expense perspective. So we're always looking at, you know, where do we think we can take rents? Can we potentially renovate units and increase rents? We look at ancillary income to really think critically about, can we offer additional services to residents and then potentially charge for it and increase the income that way? And then the expense side as well, we're always looking at it really closely, understand, you know, look, what's the staffing at the property? Is that appropriate? Can we have less? Should we have more? And then looking at the contract side too, to understand, you know, what are the contracts that are in place? I know one of the things at this particular property is we looked very closely at the landscaping contract, and we found through our due diligence that, holy cow, the landscapers are coming in once every week, which is really a lot more than what you need for a property like this. So that's been a pretty good area of savings for us in year one. We kind of looked at that contract and said, hey, look, if they come in once or twice a month, that's probably a lot better and a lot more appropriate for this kind of property.
Gotcha, thank you. Tyler. Do you have any other question, Mark, that you would like to know? Maybe you can touch base on the tax side, since you are a tax expert.
All right, let's talk about bringing down the numbers here. So we got some great information from Tyler here, and I want to. This is what I see when I'm looking at this place. I see a lot of opportunities for depreciation, and I'm going to walk you through what's going to happen with your money as a limited investor in a project like this with Tyler once you give him his money. So look at this.
But I will finish with Tyler. We can ask him more because he has to go.
Let's keep Tyler here. Let's keep Tyler here.
But
Let's actually not any of this. Don't edit any of this out, by the way. We're going to keep it natural.
I like it better like this.
So here's what I'm seeing here is right now, Tyler's going to do a cost segregation on this property, and we're going to create a lot of tax losses here. Depending on what year you are watching this video and what happens with the election, the tax code is going to impact how much depreciation is generated from that cost segregation study. But I would approximate somewhere between 20 to 30% of purchase price or the investment of the LPs turning into a tax deduction from this cost segregation study. And what's going to help increase it? We got the pool. All this pool right here is a nice source of 15-year life land improvement bonus depreciation. You might get some up front, some compressed over time. Also the fencing right here, bonus depreciation. You're also going to see here when they do the renovations, they're going to try to increase the value of these rentals, and they're going to do some renovations of the cabinetry, maybe install new stoves and refrigerators, all beautiful sources of bonus depreciation. Unless you are a real estate professional, or maybe a small handful of you guys have passive income, you're not going to see a lot of reduction in your income from these tax losses. They're just going to sit on your 1040 and carry forward and carry forward. And that's not a bad thing though, because here's what's going to happen. They're going to improve the value of the property, drive efficiency, reduce costs, and eventually they're going to do a cash out refi, and you're going to get maybe 20 to 40%, wouldn't you say, of your contribution back?
Potentially.
Yeah, potentially.
So how long are you planning to hold this property for?
So we've got 5-year fixed rate agency financing for this particular property. So it probably will be pretty close to a 5-year hold period, but it's one of those things where you can never know for sure. There's a lot of market factors that kind of go into it, but as of right now, that's what we had planned for.
So yeah, so basically sometimes they have the opportunity to refi when the value goes so high, and they can borrow from the additional equity and give returns back to the investors. Now that doesn't always make sense, because if the interest rates on the refi may not make sense. So in this example, it may not be possible, but it may be possible. And so some of the things you want to think about as an LP though, you're going to have all these losses from the cost segregation hitting your 1040, and then you get cash flow from your investments and distributions. And let's say we reinvest into other projects along the way. Eventually this is going to sell for a 100% profit after 5 years. That's what we're expecting to see, right?
That's the plan.
We're going to double the money, and then there's some recapture on that depreciation. But what's going to happen here is you're going to pay no taxes on all the cash that comes in for your share of the rental income and distributions. And then on the exit, some of those losses that were unused are going to carry forward, and they're going to offset the profitability. And when you've reinvested your profits in other rentals, those are all going to do cost segs too. So you're building up this reserve of unused passive losses, assuming you can't use them and you don't have reps, and they're going to offset this capital gain, and there's a good chance you may not pay any taxes at all on doubling your money in this investment. So that's some really cool stuff.
So that's also going to increase the ROI too.
Oh,
right?
Absolutely. Not only is it an ROI, but it's a very tax-advantaged ROI. There's no way that the profit and the money coming in here is going to be it's going to be so much more advantageous than the money you're pulling in at your W-2 job or even the business that you own, because all this is being offset by depreciation and using leverage and all the tax incentives available for real estate.
Because you can also put money in different vehicles, right? Like you can put it into, like, if you want to go conservative, you can put in a CD and other vehicle. But however, you want to consider like how much is it that you're gonna left over that you can spend, right? Because a portion of it of like the earnings that you receive, a portion of it has to go to taxes. But when you invest into real estate, you get cash flow distribution. You don't have to pay any taxes.
Exactly, because the depreciation offsets it, and then you double your money. And if you plan things right, you may not pay any taxes on doubling your money.
Wow, that's so wonderful.
And one other thing too that I can mention as well in terms of like, mixing your investments, you had mentioned investing in CDs, like doing things that are more conservative. One way that we structure our multifamily deals is we have different share classes that give people different investment options if they have different risk profiles, right? So we have a Class A share, and basically that's straight 10% cash flow, but it has no upside on the end. And that particular class of shares sits higher in the waterfall, so they get the first claim on cash flows from the property. And then we've got Class B shares where they don't get that 10%. They've got a lower preferred rate of return, but they get the equity upside on the end as well. So the Class B shares is a bit more of a risky positioning in the equity stack, but you get the upside on the end. And the Class A, higher cash flow, but not as much upside. So the Class A is a bit of a lower risk sort of investment.
Oh, I see. And what about in terms of liability? What's the difference between general partner and limited partner? Maybe we can touch base on that. I understand what are the differences, but maybe you can talk about that a little bit.
That's a great question. It's one that I'm really glad you brought up too, because it's a huge benefit of investing passively in these sort of deals, is because as a limited partner, your risk is basically limited to the amount of the money that you put in the deal. You don't have any liability beyond that. Whereas let's say you took that same $50,000, $100,000, whatever it is, and you go out and buy a duplex or a fourplex or something like that. Well, let's say somebody dies on the property or there's some sort of accident on the property or something like that. I mean, your liability, of course, you'd have insurance in that situation, but your liability could be somewhat uncapped. Whereas as an LP, if you're investing in the deal, you're basically limited to the amount of your investment. Whereas the folks who are the GP, we have kind of more of the broader risk on the deal, but as an LP, again, you're kind of limited to the amount of your investment.
Awesome. Anything else to add, Mark Perber, CPA?
This is cool.
And yeah, that's why, because of this benefit combined, that's why I like to look into, like to invest into multifamily. And whether as a GP or LP, it depends on, how much involved you want to have in the property. Like if you want to go passive, so you can more like hand off, and you have more time to spend with your family and do something that what matter to you. But if you choose to be more active, participated, you maybe want to consider to be as a general partner. So that's also, you have to decide that for yourself. It depends on your goal.